Vikas Khemani with us this morning, founder Carnelian Asset Management and Advisors. Vikas, first question to you from Niraj and me is that booking ho gaya Tesla ka? Are you heading to buy one tomorrow very quickly?
No, I haven't really thought about it. I am not big time into cars, so and not that I have a lot of drive for. So we'll see how it goes.
Okay, okay. Vikas, let's start with what is happening in the markets right now. There seems to be a mood of caution because of a lot of factors. Yes, and even if I look at uncertainty on trade as one part of it, but more focused on what's happening domestically in the derivative space. Do you think that that's something that the street is not able to understand right now, whether there's a big crackdown coming, that is why volumes have sort of gotten squeezed?
Very clearly, what was happening in last couple of years, especially in the derivatives volume, with the introduction of very short-term expiries, multiple expiries, was definitely not in a long-term interest of the market. We were kind of highest volume, derivatives in the world, and we were seeing that a lot of retail was participating and losing money in that. So despite SEBI publishing data, I think, we never reduced the expiries. We never kind of worked about why to make products available which are toxic for the retail investor. So you have to of course, derivative does serve a purpose, but anything controlled can also does cause damage to the larger. So I think the recent sort of concern and or the initiative by the SEBI are good. In my opinion, and there should be more in my opinion. There's no scope for daily expiries and all those kind of things. Hedging serve purpose, but hedging is not daily required. I mean, you need to write products and especially discourage very retail investors. So I'm sure it's only over a long health of the market. And whenever something these kind of measures are taken short term, they might create some problems of pain, which is fine. I mean, Indian markets have seen many more sort of situations like this before, and we'll see in the future. So as long as it's done to correct, it's fine.
Vikas, good morning. Niraj here. Uh, last week we interviewed, one of the interviews that kind of stood out was with JP Morgan, wherein their strategy head is saying that he believes that Q1 will set the foundation for an earnings revival, and in the next 6 to 9 months, the markets could trade between 26,500 to 30,000. Now, I'm not asking you for levels, but I'm asking you for the tonality of that. Earnings revival, higher market levels ahead amidst all that's happening geopolitically. I know usually in the last 6 months that we've spoken, you've been constructive on the markets. Are you still constructive? And are you as constructive?
Okay, I think Niraj, if you remember our previous conversation where I had said that what RBI governor has done is far more important than what Trump is doing. And that kind of says my views. Basically, I think we saw last year, because of the liquidity squeeze by the previous governor and election related liquidity squeeze, corporate earnings they took a beating with 2 quarters lag, which impacted in last year in October, so September and December quarterly earning. Last year, after the new governor came, he has not only cut the interest rates by 100 basis point, but also infused a lot of liquidity and let currency be its own. And that has had a huge impact in terms of liquidity in the system, and that obviously will impact positively to the corporate earnings with the 1 or 2 quarter lag. And that's a reason I think we've been saying that we will see 14 to 15% earning growth, where most of the market has been negative about the corporate earning growth. And through the fall of April and tariff tantrums, we never reduced any exposure. We continue to remain invested. We were heavyweight on banking. And you will see a lot more corporate earning upgrades in the second half of the year, primarily supported by this hypothesis. There's nothing wrong with the Indian economy. All drivers of the growth are intact. Manufacturing is doing well. Banking is in pink of health. So most sectors are investment cycle is going very well, both private and public. So when everything is fine, I don't see any reason why corporate earnings will not grow. Fortunately, we have a situation where monsoon is also seeming to be normal or above normal. So I think all situations seem to be falling in place. And then if that's the case, then why earnings would not come through is beyond my understanding. Hence, we've been very positive. And I continue to believe, I remember we said on a call of 15th April with our investors that I don't know when, but this financial year we will hit new high. And it looks like that, we will be on that trajectory and we will do well.
Vikas, just wanted your take on this Jane Street saga. And now SEBI has also come in and confirmed that they have received this 4,800 odd crores from Jane Street in the escrow account, which means Jane Street will be free to trade. What they have told us is that they may or may not start immediately. SEBI says their request is under examination. But in terms of the outcome of this, what do you see as the impact? Some relief for capital market stocks which were impacted earlier, but what is the impact that you see for the industry as a whole and for those investors who are in the market right now, where Jane Street could just come in and swoop in and did what it did?
I think, see, every time there is some excesses happen, it is job of the regulator to kind of correct. If you remember similar kind of situation which was happening in unsecured loan last year, and RBI came and gave a nudge, and some NBFCs and sectors and banks got impacted, but it was in overall health of the system. I see similar to this like that. I think, of course, I don't know the details of the case and SEBI is investigating. So from the looks of it, it appears that there was a lot of manipulation happening, pumping and dumping and trying to influence the expiry price and make money from there. So somebody was trying to benefit by manipulating the price, which is not a fair discovery, which is just using money power, and which in some sense typically happen in many operators case who use the low floating stock to kind of manipulate prices. So these things do happen, and retail investors get carried away with that and do suffer from that. Having said that, I don't know the details of the case, but so if SEBI is taken the correct, it's good that those kind of people, if that is true, are discouraged from participating in the market, and the fair system built where there's a fair pricing in the fair price discovery in the market, and all these things are good for long-term capital market players. While they might create short-term pain for the players who are benefiting from this trend, whether it was volume or otherwise, but long term it is very good for the market because this is trying to keep the sanity and health of the market in place. And so I don't get worried with that, because as India grows, there is no other way but for capital markets to grow further. So if you take 3-5 year view, markets and intermediates, people who intermediate this capital channelization will benefit.
I'm wondering, let's switch back to now earnings, because earnings is going to be on the big focus. We saw one large IT company, one large retailer coming in. Both were disappointing so far, because the overall mood and consensus seems to be that Q1 will be the turnaround quarter compared to a fairly dismal FY25. Is that a view that you are seeing as well, or is that something that you concur with?
That's why I said that Q1 may not be, like the critical deciding factor, but in Q1 results may not be bad as well. So I think the expectations are low. Market will get fluid, and it cannot be, each sector has its own way. But directionally speaking, I think Q1 will be better. Q2 will, in my opinion, will be even better. So I would not bet too much on Q1, because in Q1 also was significantly mired with the tariff-related uncertainty. There were shipments which were getting delayed. So I would not read too much in the Q1. Even if there is some disappointment, I will not be worried, because it was a heavy negative or uncertain news outflow quarter. And to some extent, these things tend to have on businesses, specifically in the trade, manufacturing, imported related. Banking sector should be well. In my opinion, you will see good numbers coming out from there. But generally speaking, I would not be very disappointed, even if some disappointments come in this quarter. Q2 should be a quarter where I think you should look for directions.
Q2, look for directions. Even among that, let's go a little deeper, Vikas. In Q1, IT pack, do you have very low expectations right now? Because that is when surprises can come in sometimes. How are you looking at it?
I think, see, again, the IT is a sector where you can't get a lot of surprises, and we don't really get carried away by, 5, 10, 15 basis point of plus minus here and there. You take a view from a structural point of view. IT is, I think, order wins of most IT companies were last quarter also was decent. I don't think there will be any, bad. So they are, and we don't play in a very large cap IT sector companies. So for us, identifying the right winner from a direction perspective is far more important. And generally speaking, we are not very negative on IT. I think IT will not be high growth sector, specifically in the large cap space, but IT will not be a poor growth sector either.
Okay. Vikas, you started off this conversation and even the last time saying that the RBI moves arguably were the most important thing, right? Monetary policy currently driving everything that needs to be driven, because there is only as much fiscal headroom any which ways, right? And maybe prudent as well. The question therefore is this a new lease of life or a whiff of fresh air which will drive earnings for non-banking financial companies or BFSI at large, or not quite? Because I mean, there are 2 or 3 promoters who've come out and said that they are extremely constructive on how growth can be in the NBFC side. Are you as bullish?
Yeah, I think, see, definitely, because the liquidity had direct impact on the banks and non-banks, NBFCs. So, we've been overweight in this sector for last almost 6 to 8 months, ever since we saw this whole, RBI governor started making this move. And most of them have done well. I think it can still has a lot of room. I think the fundamental message which comes from him is that his policies are going to be growth oriented, and especially fortunately supported by the environment of low inflation. And that and that's the again true job of a regulator, to kind of give a boost when it is needed, and to kind of curtail when it is overheated. And hence I think, especially in the time of global uncertain macros or global news around tariff and all, I think it was a great godsend move by RBI to give a bit of support to the economy. And and I think it should continue for some more time. So we are quite positive for sure.
By the way, some of the pharma names today are making some good moves, viewers. Keep in mind, Laurus Labs is up 3% now. And the reason I cite this is because I want to talk to Vikas Khemani about pharma, because that's a very, or healthcare, it's a very, how do I say, chalk and cheese impact being seen today in healthcare. Divi's, because of specific reasons, is down. Newland, Laurus, etc. are up. And Vikas, I know that you've been very constructive on this CDMO bucket for sure, but in general, you've been constructive on healthcare as a bucket. Some of these valuations now start to look a bit stretched. Laurus, for example, Newland with its really poor performance in FY25, and all of these. So are you still constructive, or do you believe now valuations bake in the positives?
So it really depends, Neeraj, on your time horizon. So if you take 3 to 5 years view, in my opinion, if you have said, and you know that, and it's public knowledge that Laurus has been one of the large holdings. We've been holding since I think around 350, 360 levels, when nobody was a buyer in the stock. But so the reason why we bought was that there's a tailwind of the sector, and that time there was a short-term negative for the company. The sector and capability of the management did not, sort of change. That was actually good. Hence we bought it, right? And so if you take, it might happen that after such a run-up, stock might not do anything for next 6 months, and to that extent, you might feel that it's baked in. But if you take 5 year view, I do believe that given the CDM was an opportunity space, and the capability of some of these managements is very, very good, and hence you will see future leaders coming. And I have said in the past also, I won't be surprised in fullness of time if many CDMO companies are like 10, 15, 20, $30 billion market cap companies, and they will, like how it happened in case of IT. So we see this with that lens, and hence we will not be super perturbed about what happens in next 6 months.